Sometimes the biggest cash leak in the business is not a vendor, a bad customer, or payroll. Sometimes it's the owner. And that is uncomfortable to say because most owners are not being reckless. They're trying to survive, provide, reward themselves, and justify the risk that they took. But the numbers don't care how hard you've worked. The business can only support what the business can support. Well, welcome back, team, to another episode of Past the Balance Sheet. Kash, glad to see you again. I trust that you have had a busy weekend, a busy long weekend juggling all of your priorities. Hopefully, you had a good one.
It was a good weekend. I been it's just been a busy season. We're like in the midst of AJ's getting ready to leave for some training.
Mhm.
My mom is in town, my kids are out of school, running a business. Yeah, all the things. Yeah,
Just as
all
I
the things.
expected.
Yeah.
Same here. Just slightly different things occupying my mind. Alrighty. Well, today we are talking about a very complicated everyday business reality. Owners withdrawing cash from their own business. So, owners do have an equity stake on the balance sheet, but often the timing or the legitimacy of that cash withdrawal counters with the needs of the business.
Mhm.
This is very uncomfortable for the finance department. So, let's dig into the discomfort together. So, first, let's paint that financial statement stage. When we look at our balance sheet, there is a component there of equity that really is, it's owner's equity, but there are different
Mhm.
components to it. We have the original contributions, we have the retained earnings from profits and losses of the history of the business. We've got the profit or loss for this year, and finally your distributions, what the owners have taken out. So all of these components are comprise equity, and but owners don't really think about all of these different components. They aren't thinking about, how much have I, accrued throughout time, what's how much should I be taking out against it, when the need happens, they pull money. So let's look
Mhm.
at it from their perspective, their attention. So, the owners, they have the skin in the game, right? They carry the risk, they sign the debt, they deal with the employees, the vendors, the all of the fires that when their workers, are at home with their families, they're
Mhm.
worrying about that. So I definitely understand that, the mentality that goes in with this. Um, so when money comes in, it feels reasonable to take it out because you have a right to it, right? And sometimes it's reasonable, but the problem is when there is that disconnect from what the business can actually afford. The owner is trying to pay for their personal bills, their personal needs, but the business needs might not always align with that. So the issue is not whether the owner should get paid. Obviously they should, but the issue is whether the business can support the way that the owner is getting paid and pulling out funds.
Yeah, I mean, I don't have much to add there. It is this dance. And one thing that's very, very important to touch on here is the structure or the tax structure of the business
Yes.
because and why that is so important is because yes, you need to have cash in the business, but a C corp is taxed very different than an LLC. And when I work with business owners in an LLC versus a C corp, C corps are usually looking at dividends. If the business can handle it, there's usually some sort of formula that the business is working on what those dividends look like and when they can do them. However, in an LLC is a pass-through entity typically. And so what that means is that the revenue coming in is getting taxed whether it stays in the business or not. And so a lot of times what I see with small business owners, specifically LLCs, not taxed as S corps. I'll get into that in a minute, but in LLCs, they do want to keep money in the business because you need to be able to operate the business. But the caveat there is that they're going to get taxed on that. And so keeping it in the business is not always beneficial for them.
Hmm.
And this is where having, and we've talked about this a lot in different episodes, but this is where it's so important for your day-to-day bookkeeper, CFO, controller to have this partnership with the CPA and also be including the owner and having an engaged conversation on, does it make sense to do a distribution? And if you don't do a distribution, what implications do you have personally? On the S corp side of things, the S corp is so interesting to me because one of the biggest pitfalls I see with an S corp, there are a lot of benefits to being taxed as an S corp, but owners don't, either they're not engaged in the conversation on what is happening in an S corp, or they're not engaged in understanding all of the rules that they have to follow in an S corp. And so in an S corp, you have to take payroll. You
Hmm.
have to.
Yep.
It is part of the taxation rules, and you have to take a reasonable payroll, not a distribution. A distribution is
Hmm.
different than payroll. You have to take reasonable payroll. If you pull anything in addition from the business, that is a distribution. And this is where it gets so convoluted with business owners that typically start as like a hobby, or, it's something that they don't expect to get as big as it does. When you start your business, majority of the time, 90 plus percent, it started as an LLC. One of the big errors that I see is that engaged conversation with the CPA on, when do I need to elect as an S corp and when do we need to switch over to a C corp? Just because you start as an LLC does not pigeon you into a corner as an LLC, and it doesn't always make sense. So I threw a lot out there, but yes, on the top level, I do agree with you that um, this is such a convoluted, complex topic that cannot be have a one conversation, set it and forget it. It's got to be a consistent conversation, at least annually.
Yeah, you touched on some good nuggets there in terms of different structures, different company structures, and also, with that come the different compensation types. So to your point, so there are different ways that owners can get paid. It can be through a structured payroll, or I've seen it called guaranteed payments before. Kind of same
Mhm.
concept. It's taxable income to them. It's and write-offable expense on the books. Um, or, then there is the distributions, and you probably have been in the similar world as me, where you've seen owners take a combination of both.
Mhm.
Or to your point, an S corp forces you to taking a salary. Um, but there are nuances and complexities to it. Like I have been working closely with my CPA because I do have an S corp, and when I have fluctuating income, then we figure out, okay, my salary is going to be different this time. Like it's all a coordinated dance of how much should I be paying myself at this time? How much can I not? Like yes, you're so right, and I
Mhm.
could not make these decisions without my CPA. He really puts things into perspective for me. If you are counting on a quarterly distribution, then you really need to have a specific plan with your CPA of, like, if we hit these revenues or these profits, then this is what the schedule is. This is something that's usually kind of pre-planned with a budget
Mhm.
and all of that,
Yeah.
because again, you don't want to be making this decision last minute. It really needs to flow with the ebbs and flows of the business. So typically, the finance department is the last to find out. So typically, the owner kind of has this mentality of like, well, I know that I'm looking at the P&L here, and it shows that we have profits. So if we have profits, I'm going to be paying taxes on those profits, so I have a right to withdraw some funds. And so
Mhm.
you rarely see the owner looking at your balance sheet and looking at the P&L and L and making that decision. We often see this after the fact, either when we're short on cash, either when we
Mhm.
find that we're short on our cash commitments and we're stuck doing some uh, transfer gymnastics, or
Mhm.
the bookkeeper is reconciling at the end of the month and they're seeing, oh, okay, there was a distribution. There's very little, usually little planning or kind of advanced warning that goes with that. But what that decision then leaves the finance department with to figure out is basically, oh my goodness, how are we going to get cash to cover operations? Because what the owner isn't thinking about, they're looking at the P&L alone. Then they're looking at profits, right? I was profitable this month, or I'm profitable this month, or I was profitable last month. But they're not thinking about the things that the accountants are thinking about. The fact that these
Mhm.
profits, they are not just sitting in the bank. Like they're tied up in various places. So we
Yeah.
talk about this like we beat this one to the ground. They might be sitting in your accounts receivable. So you've earned the income, but you
Mhm.
just booked it. Like, you have to take into account that there is a cycle, there are terms. So you'll probably receive it in 30 days, maybe sometimes 45 or even later,
Mhm.
depending on your clients. So they might be in accounts receivable. Construction businesses are, they have another side a category of receivable, which is retainage, which is,
Mhm.
kind of it can be 5 or 10% of, yeah, every billing that we pay you on. We're retaining this much for until the end of the job. If we're happy with the job, we'll pay you the rest. But it's kind of that security blanket of things going wrong,
Mhm.
and that can add up. That can really add up on those big commercial jobs. Um, Other thing is inventory. So okay, we have profits, but we just blew through all of our inventory to produce those revenues. So now we gotta get some more. So reinvesting back into the business to make more to make more revenues. So it can be an inventory, it can also be in equipment and things that you don't really think you're planning to buy more equipment, or you're paying a lease on equipment, or a loan that, again, you are not seeing the full picture. If you have debt and
Mhm.
you're paying off the principal, like, you're not seeing that side on the P&L. So essentially, like, what we're talking about here is you can have a situation where your business is profitable, but you can't justify cash distributions on top of it, to owners. And so that's that disconnect of, those balance sheet items is very much what we see very often in,
Mhm.
when owners do not warn about those distributions. I'm curious
Yeah.
about, yeah, go ahead.
No, I was just gonna say, like, I agree with everything that you're saying. Some ways to mitigate that I have found over the years is, again, engagement. Like, you have to have these engaged conversations with the owners and the stakeholders. A 13-week
Yes.
cash flow projection analysis, whatever you want to call it, but basically a rolling cash flow projection showing this is what we expect to come in versus this is what we expect to go out. Because the leaders that I have dealt with, I'm sure you're the same, like the words, you lose them. But as soon as you can give them visuals
Mhm.
of this is like, let me show you. Let me not just tell you $1 million is coming in, but let me show you this is what's coming in versus
Mhm.
this is what's going out. And it also gives that picture of, we were profitable in May, but in June, we've got a tax payment that we have to get
Mhm.
ready to make.
Mhm.
Or,
Yes.
um, you know, it's when our annual bonuses are done, or it's those things that, again, like you said, are not on the P&L, they're not on the balance sheet, but you're planning for them, they're coming.
Mhm.
The other thing that I see very often, again, is like lack of communication in they're doing something on the outside, and then they tell you,
Mhm.
"Hey, we're doing XYZ for this entity, so I need to actually have a distribution of $25,000." And I'm
Mhm.
like, "You knew this for, like, 3 weeks. Why are you just now saying this? Like, we could have planned for this a little bit better. I don't have $25,000." But that communication is so important. And we talked about, we've talked about single member predominantly. I do work on a few businesses that have multiple members,
Mhm.
and the equity is so important. So if we have any newer accountants or young accountants or even business leaders, you'd be surprised how many business leaders I talk to that don't know this. When you put the business together, there is usually, articles of incorporation, you have bylaws, an operating agreement, etc. And within these documents, it is usually listed how much percentage is owned,
Mhm.
and it's based on the contribution, right? So if we're starting a business, if you and I are starting a business, and I put in $40,000 and you put in $60,000, it's a 40-60 split. Not because that's what I want, it's because that's what was put in, and the IRS looks at the business on contribution. Now, here's the next layer to that. When you have those splits, you can change the splits, the 40-60 split if you want to go to 50-50. You do need to document it in your, organization, legality documents, corporate governing documents. But what needs to happen is you can't just change the documents to say, all right, we're going from a 40-60 split to a 50-50 split. Either you need to pull $20,000 out of the business and now we have equitable stake, or I need to contribute $20,000 into the business to get to that equitable stake. And so when you are looking at the balance sheet in terms of distributions, contributions, there's no right way or wrong way. I prefer to show your distributions and contributions in two separate line items.
Mhm.
It's still showing as equity, a net equity of what has actually been put in or taken out of the business, but I like to see it as what have I taken out versus what have I put in. But those percentages are so important because when you go to do taxes, your CPA is going to do a journal entry and either create a loan,
Mhm.
or create a loan one way or another if there's not equity, or ask for there to be a contribution to
Mhm.
level that out. And so what I mean by that is if we again are in this business and I'm in a position where I need to take a $5,000 distribution, maybe the business can't handle it, and we're 50-50 owners, you technically also have to take $5,000 also.
Mhm.
Or I take $5,000 as a loan and have to repay the business, or the business shows that they owe you $5,000 at some point in time when you can pay that. But that equity section is so important when there are multiple partners because it can't just be Cash wants to take a distribution,
Mhm.
Sassy wants to take a distribution. Cash is going to infuse the business because it needs it. You have to follow those percentage ownerships that were agreed upon, and again, they're based on actual contributions. Typically, it's cash, but you can value equipment. If I come in with $10,000 cash, but you come in with 10,000 of equitable contributions in equipment,
Mhm.
there's value in that too. And so it's super important to understand when you have multiple people involved that those percentages are very important.
Yeah, you touched on a great point of really like typically once your articles of organization really will your partnership agreement will dictate the specific percentages and everything. But to your point, we have to see this represented on the books. And to your point, it doesn't have to be straight cash. It can be equipment, goodwill, other stuff. But it needs to like when yeah, it needs to be represented on the books. And once you set that in stone, yes, you can change it, but to Cash's point, you would have to rewrite your, like, do an addendum to your actual operating agreement if you're changing any of those things past the initial starting point, and everybody has to agree to it. So there are ways to modify it, but it can't be like mid old contract and you just are in need of cash. To Cash's point, the CPA will correct it. It's going to show as basically a loan to the partners, you know, where the partners, the business is floating this, and it has to be repaid. So that great points there. I want to jump into. I'm curious because I'm like sitting on such juicy stories, and I'm like, how much of it is appropriate to divulge. But I want to start out with, like, I want to hear about your experience, whether it's one partner deal, if it's a family thing and multiple partners,
Mhm.
or just separate partners. Like, where have you seen the struggles play out in the either not letting the finance department know, or what we often see is like a certain lifestyle that is, you know, kind of taken on by business owners, and by, you know, maybe looking at certain high seasons, but then planning kind of your whole
Mhm.
lifestyle around it, and just kind of continuing on the pulling out of funds regardless of company performance. I want to see how bad did it get in your history.
That's a good one. That's a good one. So I've worked with so many businesses, and it, probably like you, when you work with a business, leaders typically are, I call them serial entrepreneurs. So when you come into a business, and I know you've dealt with it, you and I have talked about this, but when you come in with a business leader, they typically have some sort of side hustle going on, and you kind of take that on. If
Mhm.
you're super smart, you take it on with a completely separate scope of work and don't just take it on as your normal payroll. But the biggest thing that I see is, again, something has started as kind of like a hobby or something that they didn't expect to get as big as it got, and the lifestyle creep is a real thing, and when
Mhm.
they can't fund it, the business is the first fallback. I do, I have dealt with partnerships very rarely. Again, the type of people and clients that I'm working with, and I'm no exception. Like, if I don't have to have a partner, I really don't want a partner. I think most people are like that. If
Mhm.
you have
Mhm.
the ability to do it on your own,
Mhm.
there's really no reason. And so I don't have a lot of juicy, like, partnership stories because most of them would rather do it on their own. But yes, the biggest thing that I see is lifestyle creep,
Mhm.
or the lack of communication
Mhm.
in, again, doing something on the side. They're either starting another project, or they're purchasing an asset, or investing in something, and they're going to do a distribution from this entity
Mhm.
to contribute it to this new
Mhm.
entity, but they haven't communicated with the finance department on this existing entity to make that whole, and
Mhm.
the deal has already been done and negotiated over here. So
Mhm.
that's the biggest thing I see. Um, but and we talked about this too. It doesn't matter where you sit, whether you're in a small company as a leader or a colleague, or you get into um you get into a partnership at an ownership or stake level. The people aspect is the hardest part. And so, you know, my husband and I own a few businesses. We do operate them as single member LLCs.
Mhm.
We do have things written that if something happens to me, it falls back onto him. He's the beneficiary of it, and vice versa. But for me, I have chosen, this is truly my only partnership, this podcast. And we do
Mhm.
have, like, real documents on how we operate this. It is a true 50-50. Um, but I have chosen not to do partnerships because A, the relationship means so much to me,
Mhm.
and B, I just don't wanna share unless I have to. So when it comes to the accounting firm, I actually had the question today, like, do you own it yourself or do you have partners? And I said, I don't have any partners. I don't know that I would take on any partners unless they're bringing something
Mhm.
significant to the
Yeah.
table. I don't need the capital, so they
Mhm.
can't really bring capital to buy
Mhm.
me out.
Mhm.
Um, I've ran multiple businesses, high level businesses, so their experience really doesn't bring value to the business. And then it's two voices instead of one. Um, but when we started this partnership, it was very clear that like we're friends first and we want to run this successful business. We both have shared values. We have a very shared ideal outcome. um, it made sense. But it also, I think, worked because monetary value was never the goal.
Mhm.
And when you take the monetary piece out of it, it really changes the landscape of
Mhm.
things. I don't feel like it would change if this grows, but I guess our listeners will
They'll keep
will
us in check.
they will. But yeah, I just, I haven't dealt with a lot of partnerships because I think a lot of people in are very like-minded to that personality of myself, and unless they're going to bring significant value to this deal, why would we do this?
Yeah. Um, I want to bring up an anecdote from my life, and I mean, it is such a big part of my life. It's where I learned a lot of do's and don'ts. And it's very relevant to this conversation today. So, in this case, it was you touched on this. This is where something either starts off as a hobby, or in this case, it started out as a family endeavor. It was like the
Mhm.
son was a college student. He had an idea. The dad had the funds, and so they started this
Mhm.
this enterprise, and started out as super small two-person deal. Then they had some volunteers, some people working for minimum wage type of thing. But eventually it grew into a big company. Like it was I don't want to call out the the industry, but it was a very prominent business in the town where I live. And so essentially at that point, the ownership, and there were now other partners involved. So it wasn't just the dad. So the son has grown his values. He's put some of his own funds in, and then there were other outside partners at this point. So at a
Mhm.
certain point, when you're profitable, when you're going to stay in business, you now owe, like, your decisions now impact the livelihoods of the people. If you're screwing your own business, if you're pulling funds from your own business to where your business is suffering, like,
Mhm.
you're not doing a due diligence to your partners, to the workers, to anybody but yourself. And that's exactly what I've encountered. I encountered a situation where that kind of family mentality never left. And even though it was, you know, 15 plus years ago that any capital was actually put from the initial ownership, there was still that, and all of it, by the way, has been paid back. By that time, by the time that I rolled
Mhm.
into the organization, like, the prior over capital contributions, like, all of it that were considered as startup loans, all of that has been paid off. There were now new distributions happening, like a completely new slate. But what was happening is, again, distributions being taken out in sneaky ways at that, because when these folks found
Mhm.
out, they were trying to hire a very stupid person who won't be able to challenge these things. And I started asking questions because uh God, it was the worst. Like, the the funneling of the funds were it was in different areas, so it wasn't straightforward, like, I'm taking out this
Mhm.
distribution. It was, so one was essentially there was a bunch of personal expenses that of this family that went into the business. So like full remodel of the dad's place, some remodeling of the son. Though the son was a little
Mm.
bit less. In like I still wonder if he was aware of. The gravity of how much his dad was pulling from the business, but essentially
Mhm.
it was there like paying his ex their alimony through funds here, but then reclassing my work into booking them to leasehold improvements. So like totally like hiding them in different places.
Mhm.
And basically like the alimony was like had nothing to do with the business and he was writing it off on his personal taxes. So like blatant fraud happening, but in very,
Mhm.
very devious ways. But the thing that just killed me the most is at this point, at the highest point, we had 60 employees that this family was now accountable. They were at that point 15 plus years into this business, and when um, these things started getting challenged, like I would get these answers like, "Oh, well, it's our contributions from back in the day," and I'm like, These have all been paid back. Like now you're pulling funds that you have not earned." And another point
Mhm.
is there is like when you pull out funds, get taxed on them. There are tax consequences of pulling too much. If you haven't earned it, or if you've already took out everything that you've earned, like then it's a taxable event, so you
Mhm.
have to again be very, very strategic. But in this situation again, it was completely screwing the business. So when I talk about these stories of having to rob Peter to pay Paul, or whatever the saying is, where I would have to have a weekly conversation of like, who's
Mhm.
going to get paid this week? And all of our vendors were like 6 months past due. you know, all of this could have been prevented if excess cash was not getting pulled out from the business. And I was so like I remember being so PO'd. I remember like crying one time and going to and I hate crying on the job, like I judge others for doing it. But I felt the gravity of the situation. I'm like, what do we do? Like we're gonna have to close doors. Like and the lack of craps given, like they should have been crying but they were not,
Mhm.
and I was just like, guys, like you're accountable to all of us. Like this is BS. They yeah, so that was my experience that not only had to do with overfunding, like there was blatant fraud happening, but yeah, just that lack of coordination and again, as we talked about, you can be profitable.
So you touched on some really good things, and as you were talking about them, I'm thinking about myself as a business owner because yes, you're right. Like I cannot my accounting firm cannot pay for my home improvements. Like that's illegitimate use of funds. But I do want to shed light on the fact that again, you need to chat with your CPA. We are not CPAs. We know enough to be dangerous. Um, but having a very good CPA and being in communication with them throughout the year is very important because as small businesses in certain structures, you have benefits, right? And
Mhm.
so a couple of those benefits that, I'll talk about and again consult with your CPA on if this is a good fit for you, but because my husband and I own businesses together, there are times where we go to dinner and one of the businesses picks up that bill
Mhm.
because 90% of the time we're talking
Mhm.
about
Yep.
the
Yeah.
business. How are we going to pay this tax bill?
Mhm.
We have to add an employee,
Mhm.
etc. And so there is legitimacy
Yes.
around it, not
For
just
sure.
like, hey, we're going to go have a date night and
Mhm.
tonight it's your night
Mhm.
for the business to pick it up. Um, but there are things that you get to benefit from by being a business owner. One thing that I see pretty frequently too with expenses getting lumped in is auto. You do have ability to lump certain aspects of auto in. You need to
Mhm.
be very careful with
Mhm.
auto. You can put your vehicle on as a contribution, as an asset. It will show that you contributed value to the business.
Mhm.
It is a depreciable asset. You can then funnel, you know, expenses through it. The caveat to that is if it is used for personal and business,
Mhm.
you have to be able to keep clear records. And so
Mhm.
in my case, yes, my business owns my vehicle and it gets the incentive of depreciation on that vehicle. The downside to that is every single time I go to the gas station, I shouldn't be filling up on my company card.
Mhm.
Every time I go to get my oil change, I should not be putting it on my company
Mhm.
card because I do also use that vehicle for personal reasons.
Mhm.
And so if you get audited, the first thing that the IRS is going to ask for
Mhm.
is receipts.
Yeah.
How much of this was used personally? Luckily, we have a great CPA that keeps those records for us. So there's some ways that I see things. You do get benefits, and are you going to get audited for having your vehicle fully expensed on your business? Probably not. I
Mhm.
don't know. Um, but another thing is receipts. I would say 10-year the generation before us, receipts were so important. If you didn't
Mhm.
have a receipt, it was the end of all be all. The IRS, I feel like has loosened up a little bit on that. You do have to have records that show what you bought, services you received,
Mhm.
etc. You do have to be able to show when you purchased it. You do have to show how much you paid. You can't just say, I bought this car for $85,000. You have to be able to show the receipt for that. Um, and typically a proof of payment. A lot of times receipts are what are used, but you can use credit card statements are accepted by the IRS
Mhm.
in an audit.
Mhm.
Invoices are accepted as receipts in an audit in the event of an audit. Uh, Payment confirmations are accepted in the event of an audit. And so general rule, you do need to have receipts, but I do want to give some light on the fact that yes, your business cannot pick up all of the costs of your personal life, but there are benefits
Mhm.
to owning a business, and the business can pick up some of those.
Mhm.
They have to be legitimate. And another one that I see very frequently with owners is I'm going on a trip. How can my business pay for it? Like the fact that you have to ask how your business can pay for it is already a red flag. Probably not a risk that I'm going to take.
Mhm.
Um, but if you are traveling for business, you're going to a conference, uh, in the event of me going to visit you, a portion of that was a business expense
Mhm.
to go for a conference, to go for recording. However, that whole trip
Mhm.
was not business related. There was certainly personal aspects in that. And so those are the things that are really going to get you in trouble in the event of an audit. If you are saying, I'm going to Greece this year and the business is paying for it because it is a business expense, I don't think the IRS is going to let you fly under the radar for that one.
I see that one uh, most often with good clients, unethical clients, the whole spectrum, because it's it's kind of in your mind kind of easy for the business to pick up, but to Cash's point, you can, but you have to be so strategic about it. So if you
Mhm.
are like if you're in the real estate business and you like potentially might want to scope out a property to buy where you're vacationing, then absolutely book those trips together. Make sure that you have real, meetings with realtors, so you can write off a portion of that. And there are specific, I don't remember the specifics anymore, but the IRS kind of guides exactly how much of a trip you can write out, what the allocation process is. Is it like,
Mhm.
do you take the full day? If you're working, I think if you're working like 2 or something hours during, you can write off a whole day or something like that. I
Mhm.
might totally be pulling things out of my butt, as far as the specifics are, but I know that there are rules and guidelines to
Mhm.
follow. So if you are looking to capitalize on a portion of your travel, then make it legit. Otherwise, don't even bother, because that is a very common place of abuse, and that will be one of the first places that the IRS looks at.
Yeah. And another thing, as we transition a bit, one thing that I do see, and I see it now, and can empathize with it now more in, I think a lot of times some of these, I don't want to say poor choices, I would say uneducated
Mhm,
choices, because a lot of times they really are, um just uneducated. They don't know the full scope or the
mhm,
ramifications of the decisions they're making. But I heard it so frequently before I opened the firm with business leaders. And, when I would ask questions on, like, what is this expense? How, and again, I'm never judging.
mhm,
Like,
mhm,
if you go have a $500 dinner or $1,000 dinner, I don't care.
mhm,
I just want to make sure that in the event of an audit, I
mhm.
can back you up
Yes,
and not look like an idiot.
yes.
Um, and so my questions are always to justify it. And a lot of times it was met with defense,
Mhm,
and, we ran payroll and I didn't get paid, or,
mhm,
I haven't been paid in X amount of whatever,
mhm.
or the company owes me on this loan. And there is this level of defensiveness of,
Mhm.
like, I built all of this and what do I have to show for it? I
Yeah.
can't even go out to dinner, or I'm not getting a regular paycheck. And so I do want to bring light to the heaviness of owning a
Mhm,
business. Like, it is heavy, it is full of risk and surprises, and that, being on that side, I feel that. Like, now
mhm,
there are weeks where I ran payroll this week,
mhm,
and my team got paid, and there's not enough in the business for me to take a distribution this week.
mhm,
However, I know the 13-week cash flow.
mhm,
So
mhm.
I will take a distribution next week and all will be well in the world. But what one thing that I do want um to bring a little bit of light to anyone that may deal with this, when we talk about risk, the things that we're carrying are, like I said, those payrolls. How are we going to make it happen if someone is late on paying their invoice? If the business ever has to take on debt, whether it be a loan, credit card, we're the ones responsible for that. If the business cannot pay it back, I somehow have to go to my personal life and find the way to pay it
Yeah.
back. The bank doesn't care
Mhm,
if the AR was received. Um, you know, we deal with the midnight emergencies. If a customer or client reaches out in the middle of the night, in the finance world, it's very rare,
mhm,
but yeah, we're the first phone call. We're the first line of defense. We have to worry about the tax burdens. We have to deal with the bankers. We have to, give the story of what's going on in the business. And so there is this great burden. However, there's a lot of reward that comes with that, and that burden should never be put on the employees. And that
right.
was one thing in the corporate world that I never appreciated. And it was
Mhm,
not one specific company, it was multiple
mhm,
companies that I worked for that this kind of narrative seemed to come around of, like, I didn't get paid this week, or I have to carry the guarantee on this
mhm,
loan, or whatever. That burden should never be put on your employees. You chose to open this business, you chose to grow this business,
mhm,
you chose to guarantee the loan. You chose that. I chose that. And so yes, I do want to bring light to those are heavy
mhm.
burdens. I see you, I am you, and I feel you. but those you need to find your people to bear those burdens with and not put those on the employees.
Couldn't have said it better myself. And in addition, you touched on a couple of comments that, hey, like I didn't get paid or whatever. Like, and this is, I think we wanted to talk about this in a separate episode as well. But and I think we maybe even have touched on it on small levels in prior episodes. But sometimes owners they kind of go in with the mentality of like, hey, like I'll pay myself later type of thing. And then afterwards, when they're like, well, shit, I haven't been paid. Like, so now I'm taking it. Like, now I need it. And I will just say, like,
Mhm,
you never want to put yourself in a situation where you're already starting off with like um not somebody's not getting what they're putting forth, because you want to be able
mhm,
to budget your operations to pay you sufficiently, because again, what we see, if it's
mhm.
not on a standard consistent schedule, then it's an emergency later and probably in a way bigger chunk. So I would recommend, if you're going to pull funds one way or another, figure it out with your CPA. Am I going to take payroll? Am I going to take guaranteed payments? Am I going to take distributions? But if so, then they have to go through an approval process. We actually have to hit the goals. And again, if you're then nervous about, well, what if we don't hit the goals? Then try to figure something out in a normal, like a small guaranteed payment or something, but think about your own needs as well when you're doing this, because you're going to hurt the business if you end up then taking it as like unannounced emergency later. Yeah, so great
Yep,
point.
I could not
And I
have
think with
agreed more.
that, I think it might be time to start landing. I need
Landing the
my own
plane.
saying, I swear. Like, I feel like I stole that one from you. I don't have a right to say that.
It's become our thing. It's become our thing. I'm not one to, like, hold on to terms, so if it works for the podcast, it works for the podcast, it's not
All
mine.
right, love it. I'm sure that if Chris's mom listens, she would appreciate it, because well, both of her parents, his parents are um, flying people, airplane people. But anyway, I
The
want
same
to
stuff.
ask you a fun question. Um,
Okay.
what is a tiny inconvenience that makes you irrationally annoyed?
A tiny inconvenience. You wanna know what's so funny is it really does take quite a bit to get me annoyed, but the things that annoy me are so small. Like, and they're usually, like, the people that are closest to me. So, um,
Oh no.
like, my husband chewing loudly, like, I probably get whiplash at least once a week when I'm just like, "What are you doing?" And it's like, "Do you not hear yourself chewing?" Um,
I
like,
hate you.
it's the things, it's, like, the little tiny things, um, but, like, inconvenience, I don't it takes a lot to get me, like, truly riled up. I I would say, to answer your question exactly as you stated it, probably time. Like,
Mhm,
I am a huge advocate for time is so important and you can't get it back. And so when people are always late, like, I have grace.
mhm,
Like, things happen, life comes up,
mhm,
and I never wanna be that asshole because when I am, it's like my kids are then the ones to make me late or
mhm,
something happens, but I'm really talking about, like, the chronic people.
mhm,
Like, when you know, like, "Oh, I'm going to have coffee or dinner or so and so with this person," and you just already know they're gonna be 15
mhm,
minutes late.
mhm.
Like, is it really that big of a deal? No, but it makes me feel like you don't value my
Yes,
time.
yes, absolutely. And my answer is also time related, but it is it is a little bit different than yours. And one of them, I have zero rights to be to to bitch about anything. So, okay, I absolutely understand the comment about like, yes, if you're late, like that is such a blatant disrespect of the other person's time. And I am so guilty of this. Like, I may have mentioned to you, I had a friend who actually started like lying to me that we're meeting like half an hour to 45 minutes, later than we would. So then I would actually make it on time because I've just always had a history of being terrible and like gauging my driving time incorrectly and all of that.
Mhm.
And my husband hates that. Like he carries that anxiety for both of us. And when I make us late, like I feel terrible. But here are like the areas where I don't like basically where it annoys me. I cannot stand when people come early. Like, because I feel like it's disrespect the other way. Like, I said
Yeah.
2 PM, damn it, at 1:59 is still my personal time, damn it, And so this happens so often with like, get-togethers, if we're throwing like a barbecue or something like that. And it's funny, like, there are just certain people who, again, people like you who value not being late, who show up early, but, like, I
Mhm.
I can't stand it, and I tell them, I'm like, "Please don't come early," but some still do because they're like, I'm not gonna be late," and it annoys the shit out of me, but I don't have a right to be annoyed by it. Another thing, also has to do with time, but just represents itself differently is, uh hard phone call. Like, I bitch about this
I
all the
remember
time to
you
you.
saying
I
this.
like and I know that the world still there's so much of the world that still operates with, like, calling each other because
Mhm.
guess what, like, young listeners? That's what we did before cell phones existed. Like,
Mhm.
we took that chance, like, I'm gonna call them, I'm gonna take that chance and interrupt what they were doing. But back in the day, I think the other side was more excited to take a call because, we didn't have spammers calling. Like when somebody called your
Yeah.
house, like you like it was maybe exciting, like, oh, I get to chat with somebody. But even so, we had strict etiquette, like don't call after 8 p.m. or 6 p.m.
Mhm.
because typically like 5, 6, that might be dinner time. 8 p.m.
Yep.
is like respect, anybody who has kids, it might be bedtime and stuff like that. And I know that a lot of, we're in this digital world and we use all of these different devices to communicate with one another. But I really expect like the courtesy of like if you or want to take up any moment of my time, you warn me about it so I can place you into my priority list. And when I get a
Mhm.
call about where I'm like, are you kidding me? This could have been a phone call. Like this tells me that the person on the other line, like they're aware of that I have chaos going on, that I have my own priorities going on, but they decided that nope, my question is going to jump to the top of that. And I really, 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 really can't stand that. And I cannot find meaningful ways to represent that to people so they got that shit out. So some people just really they're wired that way. They're a phone call person. So anyway, that's my annoyance.
I think it's just like the ability to put your phone on do not disturb. I use that all the time. And so
Nice.
yeah, you can't bother me if I'm sleeping,
Mhm.
if I'm in a workflow, you can't bother
Mhm.
me. Um I actually my kids are in this phase right now. Are in this phase. So my oldest has an iPad and a smartwatch.
Mhm.
So we are kind of against the whole phone situation.
Mhm.
And my 2 younger ones have iPads, and the iPads, they have the ability to text
Mhm.
and call us
Mhm.
from their iPads. And I went to a networking lunch this afternoon, and I took my daughter with me, and my mom is visiting, so I knew that the boys were home with her, and my youngest called me, like, 3 times, and I'm like, "That's really weird." My mom is home, so, like, if there was really, like, an emergency, like, she would call. I finally answered, I'm like, "What is going on?" He was like, "Hi, mom. I was just calling to see how you're doing." And I'm like, I literally just left 6 minutes ago. He's like, "Okay, I was just wanted to tell you I love
That's
you."
so
And I'm like,
sweet.
"Gosh dang it, I can't even be mad at you." But, like, yes,
So
like,
cute.
these mother truckers. So, yes, I totally get it.
That's
But,
adorable.
yes. All right, my
Yes,
friends, next episode is the big milestone,
that's right.
episode 20. So make sure you come back and listen next week. At the end of the day, owner distributions are not wrong. Owners should get paid, but the business can only support what the business can actually afford, not what the owner hopes it can afford. So before the next draw, ask the hard question. Is this money truly available, or is it coming from payroll, taxes, vendors, debt, or future cash flow? If this episode resonated with you, please like, subscribe, or share with anyone who could benefit from these discussions. Thank you for going past the balance sheet with us. Until next time.